The subprime mortgage crisis. Subprime crisis and the resulting global financial crisis saw widespread panic as financial institutions and markets were brought to their knees. This simple video hopes to explain some of the factors that led to the crisis, its contagion effect, and new measures in place after the crisis. The video will also look at why some of the risk management models failed to work. The United States economy, having been through many shocks such as September 11 and the dot-com burst, was constantly feared to be on the brink of a new recession. The United States Federal Reserve thus felt it needed to step in to prevent this from happening. Federal funds rate is the interest rate at which banks charge when moving overnight loans to the other banks. While the banks determine this rate, the Federal Reserve has influence over it, as it too offers a rate, known as the discount rate, to institutions that wish to borrow money from them to meet the reserve requirements. Over the years, to prop up the economy and prevent it from falling into recession, the U.S. Federal Reserve moved to a lower discount rate, and to retain other banks as their customers, banks also followed and lowered their Fed funds rates multiple times. Lowering the discount rate entails the buying of government bonds from bondholders. The cash given to the bondholders in exchange for the government bonds added liquidity to the financial market. The lowering of the federal funds rate led to a flow of more free cash flow into the market. This led to the lowering of general interest rates. What lower interest rates essentially did was to encourage banks to lend in a more risky manner, since the cost of ensuring that a bank had adequate reserves was now lower. Moreover, with interest rates so low, banks were also able to loan money to borrowers, and in the case of the United States, potential homeowners, and they were not as creditworthy. This endeavor entailed huge risks, considering that these not so creditworthy borrowers presented a higher potential to default on their loans. To reduce these risks, the commercial and retail banks included these subprime loans as part of a package that included other less risky loans to more creditworthy customers. These package loans were known as collateralized debt obligations, or CDOs. These package loans were sold to investment banks. Later, the investment banks marketed these CDOs as safe investments that provided stable returns to investors, such as pension funds. CDOs are essentially packaged debt. Within a CDO, the debt is sliced according to its risk level. In theory, the debt of creditworthy homeowners would be less risky. Therefore, when put together with the debt of not so creditworthy homeowners, it reduced the overall risk of the CDO, since a diversified portfolio is supposed to be less risky. Investors can then decide the amount of risk they wish to take. If they wish to take less risk, they could invest in a slice of the CDO that comprised loans to creditworthy homeowners. However, in reality, different layers of debt within a CDO were not as independent from one another as initially thought. The housing loans of creditworthy and not so creditworthy homeowners, therefore, were correlated in some way with one another. The situation was worsened when the Securities and Exchange Commission lowered the reserve requirement for some of the larger banks. This, in effect, meant that the banks could loan out more money to not so creditworthy homeowners. Many of these CDOs were secured by credit default swaps. Credit default swaps, or CDS, represents an insurance against the default on a loan. In principle, holders of CDOs that also bought CDS were supposed to be able to regain the principal of the CDO in a default. While this initially made CDOs safer asset class, the whole situation unraveled when it was found that CDS were sold based on an inaccurate risk assessment of the underlying CDO. Therefore, when the United States property market saw a dip in value, this correlation in loans resulted in both the creditworthy and not so creditworthy homeowners defaulting. The spillover effect was so great owing to the number of parties involved and the high degree of leverage they undertook as a result of these loans. Ever since short recession in the early 2000s, the Fed had kept the interest rates low. But in 2004, they started raising the rates again. At the same time, there was a peak of US homeownership at 70%, and the market suddenly seemed to be saturated. In the last quarter of 2005, house prices started to fall as well, and both the market for new houses and subprime borrowers were affected. But it didn't end there. Since the investment bankers had packaged the subprime mortgages into CDOs, everyone who owned a security backed by a CDO was affected. When the subprime borrowers couldn't stand the higher interest rates, they started to default on their loans. The banks then took control of the houses, but this didn't help, since no one was buying houses anymore and the value of the houses decreased drastically. As the house prices kept falling, even the people who could pay their mortgages walked away from their homes, since it didn't make sense anymore for them to pay back a loan of, for example, $300,000 for a house now only worth $90,000. With this wave of default spreading, the CDOs started to default, and the banks and investors, which were highly levered and depending on these CDOs, also started to go bankrupt. For most of the 20th century, mortgage lending took place in banks or credit unions. The mortgages were usually fixed rates, and the financial institution who issued the mortgage normally also held the mortgages on their books. But when Fannie Mae and Freddie Mac became government-sponsored enterprises in 1968 and 1970, things started to change. Fannie Mae and Freddie Mac created a liquid secondary market for mortgages. By securitizing mortgages in the form of mortgage-backed securities, MBS, they enabled financial institutions to sell off their mortgages and thereby free up their funds such that they could issue additional mortgages. Because of Fannie Mae and Freddie Mac's GSE status, the marketplace had the perception that the federal government would step in and bail out these organizations if they ever run into financial trouble. Therefore, they managed to borrow money in the bond market at a lower yield than other financial institutions. And with this funding advantage, they purchased and invested in a large number of mortgages and MBS, and this with lower capital requirements than other regulated institutions and banks. When Wall Street joined in the securitization profit pool, Fannie Mae and Freddie Mac saw their market shares drop, and therefore they also began purchasing and guaranteeing an increasing number of loans and securities with very low credit quality. When the housing bubble burst, Fannie Mae and Freddie Mac started to experience large losses, and the Federal Housing Finance Agency concluded that they would soon be insolvent. And in 2008, they put companies into conservatorship. Fannie Mae and Freddie Mac had in 2008 owned or guaranteed about half of the US $12 trillion mortgage market. Their bonds were owned by everyone from the Chinese government to money market funds and retirement funds of hundreds of millions of people. If they were to collapse, there would be a massive global crisis. Instead, the US taxpayers were left with the losses of Fannie Mae and Freddie Mac, and the national debt ceiling was increased from $800 billion to $10.7 billion in order to support the organizations. As Fannie Mac and Freddie Mae were saved by the federal government, many major banks were not. One of the major financial service firms Lehman Brothers collapsed and filed for bankruptcy in 2008, and it still remains the largest bankruptcy filing in U.S. history with over $600 billion in assets.
So, how could this happen? Why did the financial market theory regarding pricing of credits not work? Normally, you would expect the risk of the CDOs and the CDS to be estimated correctly and priced fairly. Thus, the surplus of the CDOs buyers and the CDS sellers should cover the losses. But several assumptions about the market were not correct. Firstly, the price of the risk premium should be openly available and correct. If you buy an asset, you should know about the risks you're facing. In reality, you trust in the rating from rating agencies such as Standard & Poor's, Moody's, and Fitch Ratings. But in the case of the CDOs during the financial crisis, the rating agencies underestimated the risks and therefore gave them a higher credit rating than justified. One of the reasons for the misrating was the underestimation of the correlation between the defaults of the credits. As Nobel Prize-winning economist Joseph Stiglitz said, they were the party that performed alchemy that converted the securities from F-rated to A-rated. The banks could not have done what they did without the complicity of the rating agencies. All financial institutions relied on this misrating of risky securities, and this was one of the main reasons for the financial crisis. The underestimation of the risks in ratings can also be explained by the moral hazard problem of the rating agencies. As they get paid by the issuer of the CDOs, it's in their interest to give them a higher rating, as this will increase their future business. As the issuing banks know that they will sell the securities to a third party, they have no interest in obtaining a correct risk estimation. Instead, they care about maximizing their leverage and volume in order to make as much money as possible. In a perfect market, all relevant information should be available to all parties. In the reality, CDOs were like black boxes to buyers. The buyers of CDOs had to rely on the credit rating and could not assess the risk of each credit in the CDOs by themselves. Normally, you would also assume that each market participant is responsible for their own actions. However, this assumption did not hold during the subprime crisis. Firstly, traders and managers were compensated depending on the volume and profit they generated. Thus, they were rewarded for taking high risk in the distant future, even though they knew that this system could not hold in the long term. As an S&P employee said, "Let's hope we're all wealthy and retired by the time this house of cards falters." Secondly, the big banks could rely on being saved in the case of bankruptcy. Since they were too big to fail, they didn't have to pay the price for the risk they took. This all led to the collapse of the risk models. The underestimation of the risk resulting from inaccurate ratings by rating agencies and the self-interest-driven behavior of the investment bankers both played big parts in the collapse of the financial system. What changed since then, and how do we ensure that this does not happen again? For once, the financial system is more regulated today. For example, Basel III and the Dodd-Frank Act both contributed with new regulations for capital requirements, leverage ratios, and the capturing of risks. There has also been a change within the market for rating agencies, supported by the Credit Rating Agency Reform Act. This has led to a slightly increase in the use of other agencies than the Big Three, as well as the formation of new foreign agencies. In the end, the future will show whether the changes in regulations will prevent a new financial crisis or whether the next bubble is already about to burst. Thank you for listening.